Welcome back, everyone, to another episode of the Investment Hound podcast with myself, Adam Boogie, and my granddad, Mr. Paddy Stronge. One thing that I realized, Grandad, that I haven't actually been doing in the previous podcasts is I haven't actually been shouting out the book when we were recording. So I want to do it this time, okay? So if you haven't already, make sure you go grab yourself a copy of Grandad's new book, Successful Investing: How to Make Money in the Stock Market from Real Life Experience. If you're listening to this on YouTube or on Spotify, you'll be able to find the link to the book near the top of the description down below. So make sure you go grab yourself a copy. And for whatever reason, if the link does not work, just type in Paddy Stronge with an E into Amazon and you'll find it. Also, make sure you go and follow us.
Amazon.co.uk or Amazon?
Any of them.
And also, if you look over at the back of Grandad, you'll see the book.
You will. Yeah, there you go. That's it.
So maybe you start again.
If you want to go grab yourself a copy of Grandad's book, Successful Investing: How to Make Money in the Stock Market, make sure you go and grab yourself a copy of it on Amazon. And that's what it looks like right behind Grandad. Okay. Also, make sure you go follow us on our social medias at The Investment Hound. We're on Instagram and on TikTok. And also subscribe if you're listening to this on YouTube, and subscribe or follow if you're listening to this on Spotify. Okay. Now, let's get started. So, if you haven't watched the last maybe 3 or 4 episodes of our podcast, myself and Grandad had decided to build our own investment portfolio using all of the information that we've learned to date from the podcasts, and also using the information from Grandad's book. So currently we have 8 shares in our portfolio. We have, and I'll go through them quickly. We have Whitehaven Coal Limited, who are a coal mining company. CVS Health Corporation, who do healthcare and retail pharmacy. We have Volkswagen, the automotive company. Adecco, who do human resources and staffing. Banco Santander, banking financial services. Total Energies, who do energy, so the oil, gas, and renewables. And last week, we added 2 new ones. We added Sunoco LP, who are energy or fuel distribution company in the States. And we also added Ryanair, the low-cost airline. So we have 2 new shares to add in this week that Grandad picked. So I picked 2 from last week, and Grandad picked these 2 and got me to go and analyze them and make my own decisions. Now, Grandad, before we start them, I want to say, right, that these 2 were actually 2 of the hardest ones to analyze, okay? I found the financials very tricky on them. And normally when I try to analyze them, Grandad, I try to think, first of all, I think, what do I think of the financials, okay? But then I also try to think, what's Grandad thinking of the financials here? Because obviously you have way more experience doing this than I do. And I tend to kind of pick out the companies that have easy to understand financials. But I found these 2, okay, particularly the first one that we'll look at, very tricky to kind of wrap my head around. So I think we're in for an interesting one here, okay? So the first one goes by the name of National Australia Bank. So National Australia Bank, or the ticker is NAB, is one of the largest financial institutions in Australia, offering a wide range of banking and financial services. These include retail, commercial, and corporate banking, wealth management, insurance, and investment services. So founded in 1893, so they're over 100 years old, National Australia Bank operates primarily in Australia and New Zealand, serving millions of personal and business customers. The bank also had operations in Asia, the UK, and the US, though they've cut down on some of their international business to focus on their core markets, which is mainly Australia and New Zealand. National Australia Bank emphasizes digital banking and innovation, aiming to enhance customer experience through their technology. So their primary listing is on the Australian Securities Exchange. Their market cap is about 118 billion Australian dollars. So I believe they're the leading bank in Australia. Is that right, Grandad? The biggest bank.
They're certainly one of the 2.
Yeah. Their price at the minute is about 37.5 Australian dollars. The dividend yield is 4.2%, and their dividend payout ratio is 75%. The PE ratio is 18. The beta is 0.9. A lot of the analysts are rating it I got mixed results from when I looked at it. I saw a lot of buys, a lot of holds, primarily a lot of holds, and a few sells as well. One thing that I want to include this week, Grandad, as well, is what the analysts predict the price forecast to be over the next 12 months. So if anyone at home has a Financial Times subscription, if you go into the forecast tab, you'll be able to see that they rate it or they give you what they predict the highest value of the share price to be over the next 12 months, the medium, and then the low. And the highest that they predicted it was minus 1.3%, with the medium being minus 11 and worst case scenario being minus 33. And of course, because they are banking, they are highly cyclical. So, Grandad, before I give what my view on the share is, what's your view on the share?
No, you've got to give your view.
Okay, I'll
give you mine.
Okay, I'll give my view. My view.
We're buying it anyway, right?
Okay, yeah.
But the question is, are you happy to buy it, or would you be unhappy to buy it?
Well, I think at the minute I would be slightly unhappy to buy it, and my reason is because the dividend payout ratio seems to be unsustainable, and they're paying out 75% of their earnings to a dividend, and it's not even like the dividend is high. The dividend or exceptionally high. The dividend is only 4.2% roughly. So I think that would make me hesitant to get in now. Also, with the analysts, the mixed views on the analysts, as well for their price forecast, none of them were positive. They all predicted to go down. In relation to the PE ratio, it's not too bad. So in terms of how the company is valued compared to their price, it's not too bad. It was the 18 is the average for banks in Australia, which is okay as well. It's okay to only measure this one by Australia, in my opinion, because a large majority of the revenue is generated from Australia and New Zealand, and it's a minuscule percent generated from international business. However, they are significantly over the global average, which the global average for banks is 10. Now, so what I would do in this situation, Grandad, is I think that there's blood coming, but I don't think they're bleeding yet. Or I don't think there's blood in the streets yet, you know what I mean? So I will kind of hold off for the minute and then jump in maybe in a few months' time or a year's time.
No, we will put it in anyway.
Oh, yeah.
And
that's what
we will actually record that you really didn't want to buy it at this point.
Well, what do you think of it?
I put it in because it's one of the last shares that I sold. Right? Yeah. No, I didn't sell at all. My problem was I put about $5,000 into the shares, and they went up by 35%. And as you know, I say in the book, if your shares are up by 35% or down by 35%, you should really shake the tree and say, am I happy to stay where I am, or should I sell, or should I buy? And because I was 35% up, and my understanding of the analysts is most of them are saying sell. Okay. On the other hand, I'm up 35%. And the dividend is rather poor. And the payout ratio is rather high. In fact, it scores poorly in a lot of different categories, to the extent that it's the one of the 22 shares that I have in my portfolio, it's the one that they're telling me sell the most of. So I was up at about 7,500 in valuation. So I sold 2,500 worth. Okay. And I bought another bank, HSBC. Now, HSBC, as you can imagine, okay, is a bank that operates in Asia, which is highly risky, but of course is the fastest growing area of the world outside of America. It's highly risky. And it also has the old Midland Bank, there was 5 or 6 clearers, what they call the clearers, the big banks in the UK in years gone by. And the least effective of them was the Midland Bank. And the Midland Bank got together with the Hong Kong and Shanghai Banking Corporation and decided to call themselves the HSBC. And they have operated as a joint bank. And in fact, at one stage, the headquarters was moved from Hong Kong to London. And then at another stage, some many years after that, maybe 10 years after that, it moved from London back to Hong Kong. And then 3 years after that, the headquarters moved from Hong Kong back to London. And in my view, the goody side of this bank is possibly the Asian side, because they have, they're in the emerging markets, particularly around the China world and all around there, Hong Kong and so on, right? And that's where I think the growth will come. And they're running it from London. And I just think it's time for the empire to let go. However, you'll be glad to know that the dividend yield on the HSBC Bank is slightly over 7%. So I was moving from a dividend of 4.2 to a dividend of 7.1, and to a bank which is not, and people are not telling you to sell the hell out of it, right? And has possibly got a good spread of business right across the world. And so I sold $2,500 and only bought $2,500 of sold $2,500 of NAB, and bought $2,500 of HSBC. I sold another piece of shares later on and also put it into HSBC. So I have my $5 or $6 grand sitting in HSBC now, earning my 7%.
Nice.
Okay, so I reached the same conclusion as you, which was time to get out. Okay. And you were saying, well, I'll give Grandad a shot at this. I'll go in a bit later. But you were really saying that you were reluctant.
Yeah.
And so was I. But I've held on to the $5 grand on the basis that it's one of the bigger banks in Australia. Australia is a fine economy. Yeah. It's got a lot of mining companies and oil and energy and all that kind of stuff, right? And I need to be a bit more diversified. So I said, I'll take a risk on what's left.
It's also been around for over 120 years as well. So,
well, as the Hong Kong side of it has. The Midland side also has, but they weren't together.
I was talking about National Australia Bank.
Oh, National Australia.
Yeah.
Oh, yes, it has. Yeah, it's a major bank. It had operations in Ireland. You'd be glad to know.
Oh, I didn't know that.
Yeah, the National Irish Bank.
Okay.
Do you remember that bank, or maybe you don't? Remember, you're too young for it.
No.
They got out about 7 or maybe 10 years ago, and they were going nowhere. They're in the. They were also in Northern Ireland, as the Northern Bank. They originally were the Northern Bank in the whole island of Ireland, and then they split it into the National Irish Bank and into the Northern Bank. Left the name Northern Bank in Northern Ireland. The headquarters were in Belfast, but the lads in Dublin managed to snaffle, in the same way as the Midland Bank snaffled the Hong Kong piece, right, of HSBC. The National Irish Bank managed to get on top, and they ran the bank into the ground. So what they decided to do was to sell the Republic of Ireland piece of the Northern Bank, which was at that point called the National Irish Bank. So it has some connection to Ireland. And I haven't lost money in it, but I'm surprised why I'm making money in it when, in fact, everybody else is saying I should be losing money in it. So I took some risk off the table, and I went into a 7% plus dividend. Yeah.
Do you know, Grandad, just as you were saying that you bought HSBC, you reminded me, I have a bit of news for you.
Oh.
I bought my first... So... Do you remember a few weeks ago, I was not on the podcast, off the podcast, but do you remember a few weeks ago I was telling you that I was reading an article that was saying how the S&P, which is the only thing I invest in, is not actually diversifying your risk, because 30% of the S&P is being held up by the top 7 companies. And do you know? Remember I was telling you that?
Yeah, technology is a huge part of it. Yeah.
And I was thinking there the other day, I was like, well, there's actually, there's going to be a lot of political uncertainty over the next few months, so maybe now would be a good time to start moving around, okay? So I bought my first share. Can you guess which one it is?
No.
We discussed it on the podcast before. We discussed it last week on the podcast.
What was that?
Volkswagen.
Wow.
Yeah. So do you remember at the start, Grandad, I said, let's buy Volkswagen. Volkswagen was at €125, 122 euro. I bought Volkswagen at 96 euro. So So hopefully I make something on that. Now it was only 50 quid, okay? But it was the first one where I was like, okay, I've done the research on this. We watched it over the past few months go down from 120, 122, whatever it was, down to 96, and it's kind of been hovering around the mid 90s for the past few weeks. So I was like, right, it's a long, it's a massive company. I see Volkswagens everywhere. They have hundreds of thousands of employees. They've been around for, I don't know, maybe nearly a century, if over a century now. So I was like, this is going to be one that I would be happy to buy and hold on for a long period of time.
It's high risk. It's high risk, okay?
Okay.
And I don't think the dividend will survive at the rate that it's at the moment, right? But I sold half my Volkswagen in the same way as I'm treating National Australia Bank. I said, if it gets very risky, cut down on your exposure. So I cut down on the exposure to 50% of my exposure in Volkswagen, and I'm hanging on for dear life. They are in the process at the moment of dealing with the unions. They want to close down some very big factories in Germany itself. Now, Germans are like Irish people, are like American people, are like UK people. Everybody has no problem with companies closing down their factories in other countries, but they don't want them closed down in their own countries. And so it's going to be a big challenge for Volkswagen to take the costs out and reduce the production in Germany. And that's the big issue for them. Now, they're a fine management team, but the unions in Germany can be very strong. And lots of them have seats on boards and things like that. So it's going to be a battle. And I'm hanging on the basis that I think that Volkswagen will win, but they could lose.
Yeah.
That's interesting that you went for Volkswagen.
Yeah. It was one I was watching for a while, so I thought may as well start. It's also good because now I can diversify away from America and into Europe as well,
Yeah.
Okay. Let's move on to the second company. So the second company that we're going to add to our portfolio goes by the name of Bristol Myers Squibb, who are a leading American biopharmaceutical company focused on discovering, developing, and delivering innovative medicines for serious diseases. BMS specializes in areas such as oncology, immunology, cardiovascular disease, and hematology. The company is known for its research-driven approach, producing well-known drugs like Opdivo, which is a cancer treatment drug, and Eliquis, which is an anti-coagulant or something like that. Is it anti-coagulant, Grandad? Do you know what that is?
Pass.
and then they also produce.
By the way, I'm not going to die. I don't need any pharmaceutical companies.
Well, maybe that's a hint into what you're going to say for this one, but maybe the next famous drug they do is Orencia. I don't know if anyone knows any of those, but so Bristol Myers Squibb has a strong pipeline of new treatments and continues to invest heavily in research and development, often through partnerships and acquisitions, such as its purchase of Cellogen in 2019 to expand its cancer and immunology portfolio. So their primary listing is on the New York Stock Exchange. The market cap is $103 billion. Their price is $50.85, give or take. The dividend yield is about 4.8%. And this is when it gets interesting, okay? The dividend payout ratio is minus 72%. Because it's minus, they don't have a PE ratio. Their beta is 0.45. The analysts that I saw were rating it either strongholds, a few sells, but a good few decent buys as well. The price forecast over the next 12 months was the low was minus 33%. The medium or the mid was 2%, and the high was 50%. Okay, so analysts are thinking it can go either way. Their sector type here, of course, is defensive. Now, I know why, Grandad, you gave me this share. Because
Do you?
Yeah, because it's probably going to be for a different reason, okay? But I know for this one what your thought process is when it comes to pharmaceutical companies, okay? Your thought process is that they will eventually find a drug. they're obviously highly defensive because and they have a low beta because they don't operate on consumer cycles or anything like that, or they make money when they find new drugs, and this company hasn't found a new drug, or they haven't found a drug that has made them a significant amount of money over the past year. However, from my research, they predict they're going to become profitable again within the coming years with the releases of new drugs in MS and cancer areas. So I think for this one, Grandad, I think there is blood in the streets. And I think this one now is a good time to buy. Not for the dividend, not for anything like that, for the unrealized gains that you could make off this company if they do happen to buy or release a new drug that becomes highly profitable. And I think a lot of the analysts would agree with that as well, because the analysts are saying that the price forecast is going to be or could be up 50%. Now, they also say it could be down 33%, but I think that's a risk I would be willing to take. What do you think?
Well, it's interesting because I actually have bought some of it recently.
There you go. I got 2 for 2.
Now, let me just explain to you.
Yeah.
I have a share in the US market called Simon Property. And Simon Property do what they call in the United States shopping malls. Okay. And I've been talking to my brother, who was on this podcast a number of podcasts ago, who's a professor in the United States, in southern Florida, in a place called Boca Raton.
Who we had featured on the podcast.
Yeah, and I spoke to him about maybe 3 or 4 years ago, and I said to him, I'd like to support your community down there. I'd like to buy a share because, I mean, your community are looking after part of my family. So I'd like to do something for your community. Can you give me a share that I should buy? It was about 2 or 3 years ago. He said, yes, Simon Property. I said, Simon Property? Why you asked me to buy Simon Property? He said they owned a shopping mall in Boca Raton where I live. Shopping mall, I said. But we're in the middle of COVID. I said, nobody's going to the shops. And the shops that are open can't afford to pay the rent. I mean, this surely can't be a good time to buy Simon Property. Well, that you asked me for a share, and that's the share. So like a well-dutiful brother, I went and I've stuck $5,000 into Simon Property, wondering whether or not I was making the mistake of my life. Okay. And I'm up 35% in it. In fact, I'm up more.
Happy days.
So I said to myself, you know what, Paddy? I think the community in Boca Raton will be happy if I've only got $5,000 invested in it. Why should I have $7,500 or $8,000 invested in it, right? So I took $2,500 out and I said, well, now that's $1 a share. And the dollar is relatively strong. So I said, I don't want to get out of dollars now at this stage. So what $1 share could I go in? And I looked at all the different dividend yields, and for the normal shares in the US market, the dividend yields aren't very good. But I found a share that had roughly the same dividend yield called Bristol Myers Squibb, which is a defensive share. It's a pharma company which is between its last big pharma success and its next big pharma success. Yeah. It's got a 110 billion of a market cap. So, it can keep going until it finds that share. So for exactly the same reasons as you, I took my $2,500 that I got from Simon Property and I put it into Bristol Myers Squibb. And where am I today in it? I'm slightly up in it.
Oh, that's good.
But nothing to talk about, load single digit up in it, and that's because the markets are up really.
Yeah.
And I'm like you and your attitude to Volkswagen. I think they have the track record. They're there a long time.
Yeah.
And eventually they'll get it right. I also bought fairly recently, having sold, I had Pfizer. And I made a lot of money in Pfizer, particularly with the COVID, in COVID times, because they were one of the key COVID vaccines, the Pfizer one. And I made a lot of money. And I eventually got out of it because the dividend was very poor. But then went blood in the streets when the COVID was over. I went back in again. But I'm down about 10% on Pfizer. So it's another one that I have my fingers crossed on, that they'll eventually come across some blockbuster drugs, because that's what you're hoping for when you buy one of these shares. But in the meantime, they're defensive. They can afford to pay the dividend and keep going. Now, the dividend isn't wonderful, but it's in the high fours, in both of those cases. And if it shows a gentle increase each year, before you know where you are, you'll hit my 5 target. So,
I think for this one though, maybe I'm wrong in saying this, but I think maybe for you, because you put your money in this, you're not really too concerned about the dividend, more concerned about the gains you'll make. Am I wrong? All right.
Well, I like to think I should be getting a 5% dividend, but if I'm getting a 4.6% or a 4.7% dividend, within a period of time, they'd be increasing the dividend gently every year. I'll hit my 5.
Yeah.
So I was willing to sort of go slightly below my target.
Yeah. This one really kind of stood out to me when I was analyzing it, because the first thing I always check is the overview of the company, and because I do it in the order as I called it out. So I do the overview of the company, the market cap, or the price, the market cap, the dividend yield. And when I got down to the payout ratio for this one, I was like -75%.
No, but they can have a bad year, you see.
Yeah,
they can have a bad year, and they can write things off.
Yeah.
They might have bought 4 companies, and the 4 companies mightn't have got through the approval process for their drugs. So then they have to write those companies off. So there are times when there's a big exceptional hit to their figures. But it'll be business as usual next year, because they don't have another 4 companies they're going to write off,
Yeah. See, for the shares that you picked out as well, Grandad, I think, and this probably comes down to my lack of experience, but I keep picking companies that there's not enough blood in the streets with them. Like when you pick these ones here, there's clearly things wrong with these.
No, but
which are a good time to get in.
But the S&P is almost at an all-time high.
Yeah.
So the markets are high. It's very hard to get bargains when the markets are high.
Yeah. That's what I always say. You can't wait for the next recession, isn't it?
Yeah, or you can go into growth stocks, where you think you're on a winner and they're going to keep just going up, like weight loss drugs or artificial intelligence. But of course, you can pick the wrong companies there. But the technology companies are doing exceptionally well, and that particular weight loss drug, every company that's getting involved in it, they're doing particularly well as well. I don't do that because I think if you have got something big and something new, it's only a matter of time before somebody else copies it.
Yeah.
Now, in the pharma industry, there is regulations where your patent or for a particular drug, you have it for something like 15 years before anybody can go near it, and you can take them to court if they copy it. But in something like normal situations where you build a new computer system, there aren't those protections there.
Yeah, I think as well, if there's a company like that comes out with a new piece of technology, the share price skyrockets straight away, and I think then the company can just have too much hype in the media around it, and then the price becomes overinflated compared to what their earnings is. One I saw actually the other day, Grandad, was Palantir. You know that company?
No.
They do. I don't know exactly what they do. It's something like they do data and analytics software for massive companies or something along the lines of that, right? But they have groundbreaking new technology and all that, and their PE ratio is like 230.
Yeah,
and their beta is 2.8 or 2.3.
If your PE ratio is 230, you've got to perform out of your socks to justify the price.
Yeah.
Let alone have it continue to grow.
Yeah.
But some companies do succeed. But I prefer to be a bit more pedestrian in my attitude towards shares.
Yeah. Okay, well, I think we'll wrap it up there, Grandad. There is one more thing I want to ask you before we finish up here. We got an email from a listener during the week called Dennis, okay? And thank you very much, Dennis, for listening and asking us all these questions. They're great questions, and we're both really glad that you're getting something out of this podcast. But Dennis asked us an interesting question, Grandad, which I wanted to ask you on the podcast here. Something maybe we could do in the future is where if listeners at home have companies that they want us to give our opinions on, they should send them to us. And then we should analyze them in the future. It doesn't have to be in the next few episodes, but in the future. I think that would be an interesting concept.
Yeah, and just bear in mind, okay, that we can't recommend a share.
Absolutely.
But what we can say to them is, well, I think that's a very interesting share. I either have it, or I'm going to buy it, or I sold it. In other words, we can give them the information, but we can't actually, we're not advisors because you have to get regulatory approvals and all sorts of things for that. And we're not going to be doing that, right? But we'll bring you through the process that we use in judging a share, and we'll tell you what that judgment is. And that's probably all he wants from us anyway.
Yeah, just to see our opinion. I think that'd be really interesting as well to see what other people are investing in. Because he told me in that email, he said 2 different sectors, that it was like renewable energies, and I can't remember what the other one was. And I was quite interested in that, so that would be interesting.
One of the other things I wanted to tell you was, one of the shares you chose last week was Sunoco.
Yeah.
And I ran my exercise through it, and it performed wonderfully well.
Happy days.
So I decided to buy it today.
Oh, happy days. Happy days.
And I didn't succeed.
Oh.
And the reason I didn't succeed, you might be more interested in.
Yeah.
Do you remember? It was a very small share. It was, I think it had a market cap of something like $7 billion.
Yeah.
Okay. And you said to me, wouldn't that be a small share? And I said, it would even be a small share by Irish standards, right?
Yeah.
So when I got into my broker said, we don't deal with shares of that size in Ireland. Like, we don't go across to America to buy a share in a company of that size. They are the mainstream brokers here deal with bigger companies. So I put in for a Ryanair, the other one that you had chosen. So I said, okay, I'll go back into Ryanair again after many years and have a go at it.
How's that doing?
Well, I only put it in after the market. You see, you can buy in an American market after 4:30, but you can't buy in an Irish market after 4:30. So it's gone in for tomorrow.
Oh.
Hold on, let me get out of this. I'm on the phone, Martin. I'll ring you back. Oh, okay. All right. Cheers. Bye. I'm going to a rugby match on Friday.
Happy days. Well, that's good anyways, that you thought the 2 companies that I recommended were decent, so happy days.
There were 2 decent companies. I think Ryanair, it's got a very low dividend yield.
Yeah.
But
it
didn't have any dividends when I was in it before.
Yeah.
So I think it's a fine company, and it's very well run. And as we discussed it last week, so I said, okay, it didn't perform as well as the American one because of the very low dividend yield in it. So I said, okay, well, if I can't get the American one, I'll get the other one. So in I've gone.
Well, happy days. Be interesting to hear how they do. So we'll wrap it up there, Grandad, okay? Thank you very much for everyone who listened to this episode. Also, make sure you go grab yourself a copy of Grandad's book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience. If you're looking at the screen, you can see it behind them. And follow us on social medias. Like the video if you're listening on Spotify, YouTube, and follow us on that social media as well. And thank you very much for listening.
Bye, everybody.